Hello, guys. Good evening to all. My name is Utkarsh Pratap Singh, and I am going to share on my views on how to do dynamic financial modeling using Excel. So, basically, financial analysis and modeling plays a crucial role in understanding a company's performance and financial health. It involves evaluating financial statement, identifying trend, and using various tools to make informed business decisions. Among these tools, ratio analysis is one of the best effective techniques. It helps in assessing profitability, liquidity, efficiency, and solvency by comparing different financial metrics. By analyzing these ratios, investor managers and stakeholders can interpret their company's strength, weakness, and interpret the company's strength and weakness and overall financial stability, enabling better decision making and strategic planning. Now I'm going to take one example and going to show how does this actually works. Now let's start with an example that how we should create a dynamic model by using a data. So we have a data of income statement where it includes the revenue, cost of goods sold, for which we can get a cost of total goods sold, from which we can get out the gross profit of the particular period, and the operating expenses and the operating profit, for which we can calculate the total profit, net profit, or loss for that particular period. For this, we had also, it is just a proper statement function that how it's going to happen. Some of the assumptions which we have, like basically there would be a four assumption. First one would be like revenue expenses, like we have to forecast the revenue. Then second one would be the type of expenses, whether the expenses is fixed or variable, because sometimes expenses which are incurred would be a very low and some fixed expenses which is incurred on a regular intervals. Third one would be the profit and loss of the particular company and the scenario analysis by using the formulas. So this is a particular format. Apart from that, let's imagine that this is an e-commerce business for textile company for an online sum, and start filling the data for the same to get the knowledge of what is the changes in the year from 2023 to 2027. We are going to take data for the next 5 years and calculate the profit and loss of the business for the particular time. Let's start. Now, let's start with the very first thing, the very first assumption, like order growth rate. We are assuming that for the next year, the growth rate would be around 100%. And the next to that year, the growth rate would be 75%. For the next year, 50, and assuming for the last year, 35%. So, like if you want to calculate what is the number of growth for the order, so for that, the formula would be equal to the previous year, upper bracket, 1 plus the order of the growth rate. We are going to close this and enter. Let's try another time. The formula for that, the number of order, like is equal to that number is 3000 previous year into open bracket 1 plus that growth percent, close the bracket, and the growth rate for the next year would be like 6000. And when we drag this from here to here, we can assume that what will be the number of orders if their order growth rate is given. So this way we can calculate the number of orders for that particular year. And apart from that, we can also go for, in this we can assume, we are assuming that the order growth rate is changing by percentage, but the average order value remains the same for all the next time. We are making that this is the same for all the year. That 39.995 will be the same for all. So after we calculated the number of orders for particular year, now we are going to put this data into the main table. Like what will be the revenue? So for this, the formula would be is equal to 3000 into 3000 into that average order value. So this is the first year revenue, which is 1,19,850. And when we are going to drag this to the next 5 years, we can see the what would be the revenue if there would be no change in the average order value and there is a certain change in the order growth rate. So there is a standard decline in the revenue for that particular year. So as we are done with the very first assumption about forecasting revenue, now we are going for the second one, the expenses. So basically the expenses would be divided into two parts. One would be the fixed expenses and one would be the variable expenses. Talking about the manufacturing and order fulfillment, it would be basically a fixed one. Like for this, it will be a variable one. Like we are going to have the same kind of investment for the every year. So we are going to drag this till the 5 years. And same goes for order fulfillment. Order fulfillment depends upon the nature of business and the demand. If there would be a high number of order and there would be a great growth in the number of orders, the rate would be changing. Suppose this in the particular year there will be a change in the growth. Suppose we are assuming that the growth is three, order fulfillment is good three. Then from here to the next 5 years, it would be three. And the other expenses of the operating expenses are generally those expenses which are very fixed in nature, like salaries and payroll would be a similar range for a longer period of time. So we are going to do the thing same for all the all the four data. Warehouse rent is like you have to pay where you're doing business, you have to pay the same, which generally doesn't change and remain the fixed for the certain period of time. Marketing expenses can be changed if there would be any changes like salaries of the person changes from 50,000 to double like 1 lakh. We are generally assuming a data. What will happen if there will be a change in data? So like if we change the salary payroll due to order growth rate, because if we are having a higher growth rate, surely we are going to pay higher to our employees. So if it changes from 50,000 to 1 lakh, so now we are changing little bit the data from 1 lakh to 50,000 to 1 lakh for the salaries and payroll. Same goes for the expenses which we are incurring for the marketing. Like for the third year, assuming from 25,000 to 50,000. So now the table should look like this. Hmm. So basically, the other expenses like operating expenses would incurring that electricity cost, transportation cost. What are the other costs which is like fixed for that business, but are not included it anywhere else like rent, salaries, and marketing would be included in the fourth heading of the others. So putting it as a very fixed one, not going to change it much. For the next 5 years, we'll put the same like 5,000 for the every year. So now we are having cost of goods sold, which is the part of fixed and variable expenses. Like cost of goods sold would be a part of a variable expenses, which includes manufacturing and other fulfillment. And the fixed one includes all the four things. Talking about the corporate tax rate, assuming it also fixed for the all the 5 years. So we are going to put it 20% for the all the 5 years. Now we are done with the second assumption. So now we are going to put this data and going to calculate what would be the total effect of this on the income statement of the business. Let's try this. Now, as we have the cost of goods sold in our assumption, now we are going to use this. For this, we will be going to put is equal to, and we are going to put this number of order as a common thing. Then function plus F4. Then we are going to log this number, and then we are going to multiply with their manufacturing expense. We can get that manufacturing cost of manufacturing good would be 19,500. Same goes for this is equal to 3,000 function F4 into that order fulfillment rate. For this, we were getting what is the cost of order fulfillment rate. So for this, we can get for each of the year. We are going to just drag this down here. Just wait. Now, for calculating the total cost of goods sold, we are going to add this too. Now, total cost of goods sold would be is equal to sum of is equal to this plus this. For this, we can get what is the total cost of goods sold, because it is the inclusion of both the cost for the manufacturing and the order fulfillment. And for the gross profit, it would be very simple one, like is equal to, we are going to deduct revenue minus revenue minus the total cost of goods sold. This would be the total gross profit for that particular, because actually the gross profit would be the like what would be the revenue for that particular period minus the total cost which we incurred during the manufacturing and order fulfillment. The profit, it is before the net tax, so it is a gross profit. So that for the particular for first year, it is 93,600. About now for calculating the gross profit margin for the particular year percentage, the formula would be is equal to the gross profit divided by the revenue for that particular, and is 78%. So this basically implies that for the very first year, when we calculated about the revenue, which was like number of orders which we taken was 3,620, it was a fixed one. We have changed the growth rate from various different ways, like 100, 75, 50, and 35% of growth rate. Our average order value will remain the same for all the periods. So for that, we got the what would be the revenue for that particular company. Like we have taken for us is a textile company, online e-commerce business. So what would be the revenue which the company generated for the 5 years? So as we can see, there was a growth from 2023 to 2027, and we incurred the cost also we included, and about what are the total cost, what was the gross profit, and the percentage change in the gross profit margin. So now for the every year, we are going to just do this, and we are going to shift till the last year. So when we have done this, we can actually see what is the gross profit margin changes for the whole 5 year. Like as we can see, there was a huge growth in the gross profit from year one, to year two, but there is a sharp decline in the third and the fourth phase, because the growth rate was clearly higher, 78 to 99%, but the increase was kept on increasing gross profit margin year by year. So by this, we can calculate the second scenario, which was like Second assumption, first was basically forecasting the revenue, which we have done. Second was like forecasting the fixed and variable expenses, which we have done through this. And we got that these are the ranges. We got what are the changes in the fixed and the variable expenses. The same goes for the operating expenses, as the expenses for every year would be a fixed one. So we are going to put it like this. For the very first, for the warehouse rent is equal to the fixed one, and we are just going to drag this down, and we are going to get the fixed total operating expense is equal to sum. It's all for no, no, just adding for that. We are going to put the same thing. As we can see that the amount of thing is the fixed one for that. Hmm. Like total operating cost is was fixed for every 4 year. Like because huh, as we can see, there was a change in the operating expenses, but the operating expenses will remain the fixed for that 4 years. We are going to put that the same year for the all the four one. Now, as we are having for the very first year all the operating, now we are going to add up this is equal to S from all the four numbers, closing the bracket, and for calculating the operating profit, it would be like is equal to revenue minus total cost of COGS minus total operating expenses. The operating profit for that was a negative for 6,400. And as we can see that it is also a difference of gross profit minus total operating expenses, which also comes as the same thing. Now we are going to calculate how to calculate the operating profit margin for the first year. So for that we need now for calculating the operating profit margin, we are going to use is equal to the operating profit for that particular period divided by the revenue for that particular year. It is minus 5%. Then we are going to take this data and we are going to drag this for all the 5 years. So we can get the data about how does the profit margin actually occurs from minus 5% to 76%. As we're going to talk about taxation, as we all know that we can't charge tax when their operating profit is in negative. So for the very first year, we would be not charging any kind of tax. But for the next second to the fifth year, we would be charging a tax on the percent rate which was given for us. We have taken that 20%. So we're going to charge taxation on the on the profit of operating profit which got that particular year with the rate of 20% for every year except the very first year because we can't charge tax when we did then incur any kind of profit for that particular period. For that, we are going to put one formula. Now we are going to put for the taxation, we are going to put things like one if function we are going to put in which if the operating profit is less than zero, we are going to assume that the taxation would be NA, not available and not applicable. And if that operating profit is greater than zero, then the taxation would be charged at the rate of 20%. And this is the function for that. We're going to put the enter for that. It is not applicable for the first year because it is shown that the profit for the very first year was in negative. So no taxation. When we are going to drag this from here to here, this is the taxation which will be charged for the every year, which is different from different year, but the rate of interest would be same, which is 20%. But the amount is different because the operating profit for each year is different as shown here in the figure. Now, if you're talking about the profit for the particular year, how we are going to calculate the profit? Now, talking about the profit and loss for the particular year, it will be calculated will be like for the first year, it would not be any loss. It would be a proper loss of 6,400. And for the second year, it would be is equal to operating profit minus the tax which is charged. The profit would be of 90,760 for our business, as we are assuming this business would be e-commerce business for the textile. Now we are going to drag this from the second to the fifth, and we are getting the profit for every year, and it can show that what is the increase in the profit for the every year for that particular company business. Now, as we got that, for that, the last part of the assumption is the scenario analysis of that particular table. For this, we are going to do one thing. The assumption part which we taken, the assumption part, we are going to take this whole data, copy this, assumption data, not like this. We are going to take whole data, Control plus C. We are going to paste it here. And this would be like we are going to put in this some kind of similar thing, just a little bit table. This would be this, because we got the information that we are going to do the scenario analysis. For that scenario analysis, we are going to do this taking a total of two cases. One will be the assumption would be like this is the assumption. This is the will be changing this into uppercase. Uppercase. I'm going to name this scenario one. Same, we are going to take another one. So plus C, we are going to put it here, control plus V. So, control plus C, control plus V. In this would not be there. And we are going to name this as a lowercase and as a scenario 2. And this one will not there. And this assumption would be renamed as live case. Now we are going to put a scenario analysis. Now, as we are having two cases, one is uppercase and the lower case, and one is live case. For that uppercase and the live case, we are going to put it as the same, that this is the live case and this is uppercase. We are not going to change anything. Now let's change something in the lower case. Like instead of this 3,000, we are going to just put 2,000. As you can see that when we change the very first thing, the rest also change the. And for the very second thing, 39.95, let's make it 34.95. And we are going to drag this. The point to note is that we are doing this in the second lower case. We are not changing anything in the second case, in the first case. We are going all the changes in the lower case, the scenario 2. And if we talk about order fulfillment, it would be remain the same. Just change something in manufacturing. Instead of 6.5, let's put it 8%. And we're going to drag this till the last. Hmm. Yeah, there's a certain changes in the very first thing. Now let's also change certain taxation rate from 20% to 25%, not 2500, 25%. Okay, 25%. And we are going to drag this to the last. Now, as we can see that there is certain changes. Now we are going to do a scenario analysis. Now, as we have seen that income statement for the last 5 years, there was a certain increase in the revenue for that year, and so as for the taxation for also impacted, because for the very first year the taxation doesn't occur because there was no certain operating profit for that year. But we have covered with the two live cases and one upper case and the lower cases, and we have generated how does the financial modeling solution happen for the income statement. We took as an example of any textile industry, any online industry of an e-commerce business. So for today, that's all from my side. Thank you.